As we know, stocks in China are not doing so well, and it's mainly because of the government. There is one sector in particular not doing well at all, and that is the private education sector. And once again, it is because of the government. As value investors, when we see normally that a sector, an industry, a country itself is not doing so well, maybe we need to look at opportunities there, because this is what value investors do. We do the complete opposite that the market is doing. We try to ignore the news, what everybody is talking about, and look at fundamentals. And that's why I believe many of you, because I know that many of you are value investors, you have asked me to look at this company, New Oriental Education and Technology Group, ticker symbol A2. For today, I will just call the company New Oriental. This is something that I have done in the past. I have looked at companies at sectors which are not doing well, and as a value investor, I saw opportunities. Recently, for example, I invested in Geo Group, which is a private prison company, and we know that the government in the United States right now doesn't really like these private prisons, but I saw this company that is undervalued, so I look at the fundamentals and I invested. We know that China is not the United States, but still it's interesting to look at those companies which are undervalued in China. And this one, New Oriental, is selling at a price below its cash value. So if today the company has all the cash they have, they can buy back the company completely. They can take the company private. So that's why I believe it is interesting to look at this company. But before we go into details and talk about New Oriental, please make sure to smash the like button for the YouTube algorithm. If you're new to the channel, my name is Ishfaaq. I am an elite popular investor on eToro with over $2 million in asset under management. So please subscribe and hit the notification bell so that you don't miss the coming videos. First, we need to understand education in China. China has one of the best education systems in the world, and that's very important for them if they want to become a superpower. And 20% of Chinese students actually attend private schools, so it's both public and private. But China, even though they want to become a superpower, this is the same thing they have been doing with technology companies. They are still a communist country, and they want to retain the power they already have. The government there, they want to retain the power they already have. That's why, even though you may think that technology companies, capitalism itself would be good for a country to become a superpower, but China, they are trying to influence the technology companies there, for example Alibaba, Tencent, because these companies are getting bigger. It's the same thing for the education sector in China, but there it is a little different. It's not really because the companies are getting bigger, it's because mainly what those students are being taught. If the students are being taught something which is not really in compliance with what the communist dictatorship wants to teach the children, of course they are not going to be happy about it. So that's why the government in China has been implementing new and new regulations on the private schools in the last few years. These new regulations have affected the profit margins of those companies. You look at New Oriental, you will see that profit margins have been going down in recent years. But still the revenues of the company has been growing. But now things are completely changing, because now the country, China, the government, is affecting the revenues themselves. So even revenues may not be growing anymore. So what they have decided to do, they are first going to nationalize many of these private schools. This company, New Oriental, so far is not really affected by the nationalization. It's mainly targeted at smaller companies, but they are having people who had to sell their schools to the government. And another thing they are doing, they are affecting the way that homeworks or even after school tutoring is being implemented. For example, it's going to be non-profit now, and the big portion of the revenues of New Oriental comes from after school tutoring. So if this is going to be non-profit, they are going to make revenues, yes, but these revenues we can discard as it won't be converted into profits. So let's talk about this company itself, that now that we have understood what's happening in general in the education sector, the private education sector in China. So this sector itself is fragmented. There are many of these companies. New Oriental is just the largest. They are the one which has been public for the longest time. But there are many of these companies. They only own 122 schools today. But in total, there are 190,000 private schools in China. They own 1,669 learning centers, including the 122 schools. So in total, they have operations in 108 cities. But as we said, it's a very fragmented industry. So if these regulations were not here, then maybe it would have been a good thing for this company that the industry is so fragmented that they are the largest, they are a public company, it's easy for them to raise capital, they can gain market share. There is a big market share for them to gain. And that's why you will see in recent years, revenues of the company have been growing at a fast rate. But now because of these new regulations, that may no longer be the case. So they have after school classes for K-12, for high schools, even for middle school, and even for adults. They teach adults languages. They even teach for test preparations. For example, if you want to take an English test to move to another country, SATs, they have learning centers for all of this. And this is something very important in China, because as we said, China wants to be competitive. China wants to be the largest economy in the world. They want to be a superpower. So education is very important for them. But the government, of course, they want power, and they want to be a superpower, but at the same time, they want power for themselves, not for the country. So there are these uncertainties now on this company. But the company's business is not just limited to these courses. They also own bookstores. And according to the company, 60% of revenues are going to fall in the coming years because of the new regulations. Since part of their business is going to be non-profit, I don't know how the accounting is going to work on this. I don't think it's going to be on the income statement as it will be non-profit. But even if it is on the income statement, we cannot really count these revenues because it's going to be non-profit. So the revenues and the costs and the expenses will be the same. So it's total $0 as profits. Right now, the company has $4.2 billion in revenues over the trailing 12 months. And if these new regulations are implemented, let's say really they can fall to 40% of the current revenues. So it's going to be $1.6 billion in revenues next year. But you see the problem with that? The revenues are going to fall according to the expectations of the company by 60%, but the stock crashed by 90%. So that's why many people are thinking that maybe the market overreacted, because the market overreacts many times. I will once again use the example of GEO Group. Even though they are going to lose, in the worst case scenario, we said they are going to lose about 16% of revenues. Worst case scenario because of the new regulations in the United States. But it's only 16%. The stock should not have crashed so much. So it is a market inefficiency. For us to know exactly if really there is a market inefficiency, we need to dig deeper into the financial statements. First, let's look at the income statement. Once again, you will see the revenues of the company last year, $4.2 billion, with $334 million in net income. Everything seems good here. Net income of $334 million. What about the cash flow statement? How much of these $334 million can actually be converted into cash? Because cash flow is more important than net income. And here there is something very surprising. If you understand the business of the company, it won't be surprising. I will tell you why. But if in general, normally net income is supposed to be a little bigger than free cash flow. The operating cash flow itself is $1.13 billion. And with capital expenditures of over $400 billion. So let's say free cash flow is around $600 to $700 million a year, which is pretty high compared to the net income. So why this is the case? Why is the free cash flow so big? It's because of the way they operate their business. If you want to pay for a course from this company, you have to pay them upfront. You pay them, they take the cash, and then over, let's say the next 2 years, I don't know how long the course is going to be, they are going to teach you. So for 2 years, then they are going to give you the services, but you pay upfront. So that's why they have a large cash flow. And this is counted as deferred revenues. On the income statement, deferred revenues are not going to be there. You're going to see only the real net income of the company. That's why the net income of the company is so low. And the net income of the company being so low, you will see that at current price, so let's say this year they had $334 million in net income. Next year they are going to have 40% of that is $133 million. This will give the company forward PE of 27, which means it is expensive. So that's why looking at net income for this company is not very interesting. We need to look at free cash flow. That's more interesting for this company because all the payments are made upfront. But all these deferred revenues on the balance sheet are counted as liabilities. You will see that the company has a big cash balance. It's because of the upfront payment. But all of these now are liabilities. Even though the cash is entering the company earlier, eventually they have to use this cash to pay the teachers, to offer these services because they have made promises. But now that these services are not going to be delivered because of the new regulations, they will have to return all that money. The payment have to be returned. So that's why deferred revenues are counted as liabilities on the balance sheet. Because if you cannot eventually give these services, you have to return the money normally. And this is exactly what will happen. So it's not because the cash balance seems so big today that in 2 years it's going to be the same. So how then are we going to calculate the intrinsic value of the company? You can find everything on my research partnership. There I talk with much more details about it. If you're interested, by the way, you can have a 1 month free trial of the research partnership with full access to my investing course for beginners and all my analysis and also all my research. Let's talk about something interesting. Let's talk about this first. How to calculate the actual free cash flow of the company next year. With the actual net income of the company, you can expect it to fall by 60%, just like the revenues. So this is simple. Let's assume they are keeping the same average profit margin. Normally, you will see that the free cash flow margin is about 10 percentage point higher than the net income margin, than the profit margin. So if profit margin is 12%, free cash flow margin is 22%. But this is not going to be the case next year. So free cash flow margin then, I believe, is going to be only 4 percentage point higher than net income margin. It's because it's going to be lower than 60%. So this is the assumption I made, and I calculated the intrinsic value. Of course, I used a big discount rate, 20%, because in China we should expect higher returns, and of course there are more uncertainties in China. I took a big margin of safety, and I found the intrinsic value of the company, and according to me, today the company is overvalued. Even though it may look interesting, you look at the balance sheet today, but that doesn't mean it is a good company. Maybe the company is trading below its book value, but that doesn't mean today it is a good investment because the company is not going to be liquidated. Even if it is liquidated, there is no certainty you're going to be paid because you only own the ADS. So all these uncertainties need to be taken care of in the margin of safety. That's why you need to be careful. I'm not saying that this is a bad investment. Maybe you want to invest in it, you want to speculate in it, but then it's not investment. You want to speculate that regulations are going to change again and that the stock price will go up, because it can happen that this stock price double or triple in value in just a couple of days, because reality is so low today, the stock price of this company. But not for me. I need a bigger margin of safety before making an investment. The company so far has not told us how they're going to navigate these regulations. They have just said that 60% less revenues. What are they going to do? They have to give us a plan first before we can make an investment. So let me know in the comments what do you think about this company and everything that's happening in the education sector in China. Thank you for watching this video. Please like, subscribe and share. Please watch these two videos if you have missed them. Have a nice day and goodbye.